Okay, Serafino, we're live. All right. Thank you, everybody, for waiting. Thank you for your patience. We are back here on our live stream. Everything is working today. All right, welcome, everybody, to Wall Street Reporter's Investors Discovery Day live stream. We've got an exciting day for you here today. We're starting off today with a company which, again, this could be our next 10 bagger. You know, we're looking for those stocks. We bring you those stocks which have that 10x to 100x upside potential. NG Energy has some incredible people involved. I think the key thing when you're looking at these microcap stocks is who are the people? We'll talk about some of them. But Serafino, the CEO, the last energy company he was involved with, I'll let Serafino give us the story, but I think you guys are going to like it. So, with that said, NG Energy GASX. Let me just put up the banner over here. Serafino, welcome to the program.
Thank you. Thank you for having us.
Absolutely. So Serafino, I want to kind of start off with, our audience, again, they're looking for those, stocks which have that big upside potential. So what they want to know is, what is NG Energy all about? Like, you're operating in Colombia, you're in natural gas. Why Colombia? Why natural gas? What's this big opportunity? Because your team is, you got some heavy hitters there. Why are you guys so excited about this opportunity?
Sure. Let's start with the three main reasons of us being in the space that we're in. We are in a transitional world that it's coming in right now, where I think natural gas is going to play the main role in producing electricity in this world. Everybody's talking about going electric. Everybody's talking about a way of changing things. Oil is bad, coal is bad, nuclear is bad, hydro is bad because it destroys the environment. Everybody's talking about solar, everybody talking about wind, but I can give you the most important number. The largest user of solar and wind energy in the world is one of the Nordic countries, and only 5% of its energy is produced from the solar or from wind. That is the reality. The reality is that for you to have a 100 megawatt power plant, you need 500 acres of land to be around. So it's going to reach a point. The world is not going to be covered by mirrors, or it's not going to be covered by windmills. The reality is that you're going to be looking for the cleanest energy possible. And although I believe that coal is going to start declining very much, because that's the reality, and nuclear might get its moment, the reality is that the immediate winner for all of this thing is natural gas, because it's the cleanest way to produce electricity. And the world needs electricity.
Especially with all everybody's saying, hey, we're going electric, Tesla, all the e-vehicles, everything else. So they're gonna, where's the energy going to come from? Great thing. So what brings you to Colombia? Why this project that you have, and what's the upside?
Correct. The second point, Colombia. Colombia right now is it's actually starting to become a net importer of natural gas. It's got fantastic natural resources. It's got a tremendous potential. It produces 700,000 barrels of oil a day. So it's a country, it's an oil country, okay? The problem is that for the last 20 years, everybody concentrated their efforts in producing oil because oil was the pretty girl. Natural gas was a necessity. Natural gas got two problems. You need large quantity for exporting, and you need infrastructure for exporting. So you need gasification, so it becomes very local, and it becomes for local use. The thing is that the use of natural gas in Colombia has gone up tremendously. Colombia uses 1 TCF of gas a day. That's 1 trillion cubic feet of gas a day for consumption. We got 7 years worth of reserves. And we are starting to import natural gas now from the US and from Trinidad into Colombia at a price. By the time you put it into, you take it from the US, you put it on, you compress it, you liquefy it, you put it on a ship, you transport it, you decompress it, and you sell it in the local market. It's $8 to $10 per million BTUs. The gas in Colombia, right now gets sold at about, local gas gets sold between $5 and $7 per BTU. So it's still a very inexpensive proposition. What makes it exciting is that the cost of producing in Colombia, because it's very shallow gas and very good infrastructure for transporting for internal, our cost of producing 1 million BTUs of gas, it's between 90 cents and $1.50 per million BTUs. So your profits compared to oil are 10 times more than you will make. A net back for a barrel of oil might be, even at $60, might be $15 per barrel, okay? Equivalent of gas per barrel, your net back are $30, okay? So that's a big difference.
Okay, so basically you're making basically 3 times your money with natural gas.
Totally. And we are a favorite client of all the utility companies. And not only is the utility companies that need the natural gas in the country, because Colombia has a problem with, they build a hydroelectric plant that failed. That happens sometimes with these projects. And they have a shortage of 1,500 megawatts of energy that now they have to make it up, and it's going to be made up by natural gas because it's the quickest thing. So there is power plants that are being built in the country. But the most important thing that there is, Colombia is a country of 15 million people. 10 years ago, only 7% of the population had natural gas for home usage. Today, it's 30% of the population uses natural gas for heat, for heating water, for kitchens, for cooking, and for industrial use. So every year it goes up. And before it used to be cities of 100,000 or more. Now they're down to 50,000. And in 10 years, it's going to be every part of Colombia that has a possibility of being hooked up to natural gas is going to be hooked up to natural gas, also to comply with the green emission.
Okay. Yeah, the Colombian economy, the market is doing pretty well, right? I mean, there's a good economy, booming economy, right?
Colombia is fantastic. It's probably one of the best economies in Latin America. AA rated by Fitch and by Moody. Never defaulted on any loans. It's got a very strong economic backing. It grows at a rate of an average 4%, 3-4% a year, which is a decent thing, especially in this world that we live in. It's a producer of a lot of natural products. It's gone into the gold business big time. It was the third largest producer of coal in the world at one point. Still produces 120 million tons a year of coal. But they want to shift. It's also a country that is very conscious of becoming up with the world, of this world that we got to live in, and we got to worry about global warming. So natural gas, I go back in saying that it's going to be the key element, especially for countries that either they import it or they find an alternative way to produce electricity to satisfy the growth of the country.
Okay. And okay, so let's talk about what you have right now. What are your projects? Are these generating revenue right now? What do you have in the pipeline? Like what's the
We have 3 projects, 3 main projects. In Argentina, we had some project. We divested and we decided that we were going to become a gas producer, and a gas producer in Colombia. The 3 projects that we have in Colombia, we have a greenfield project, which is called Tiburon. I'll talk at the end about it. Maria Conchita, which is going to be going into production in the next 2 months, start going to generating revenues. And Sinu 9, which is our star concession, and probably one of the biggest, it's probably going to be one of the biggest fields in Colombia in the last 10 years of discovery after the Canacol fields. So I'll start with Maria Conchita, which is our near production. Maria Conchita is a concession right next to the largest producer that produces 60% of the natural gas in the country, that is called Ballena. The Ballena property belongs to Ecopetrol now. It sits in the northern part of Colombia. 2 years ago, the old management of this company drilled a well. It was drilled, unfortunately, it wasn't drilled properly. We're going to go back in the next few weeks. We're going to re-drill it and put it into production. But in the meantime that I took over the company a year and a half ago, we went into Maria Conchita and started looking at the past history of this thing and what was drilled in the past. This concession had 5 wells that were drilled in the 1980s and 90s. The first well that was drilled in the 1980s was drilled by Texaco. Texaco drilled a well. In the 1980s, you finding natural gas and not finding oil, it was the quickest way that you would get fired by a company. Nobody was looking for natural gas, for the mobility. What do you do with natural gas? You got to build pipelines, you got to build areas. So Texaco drilled, they hit 10 million cubic feet of gas. They went to drill a second well. They hit 5 million cubic feet of gas. This is Tinca, which is the second well that they did. Then they did Arruchara 2. They drilled it. It hit gas. And by the time they started finishing all the wells, they said, it's a gas field. We're shutting it down. Let's move on. So that's what they did. But what's left over from the past in the natural resource business becomes the treasure in the future. And we went and drilled Arruchara well. We reopened it. We cleaned it up, the original well. We tested it. And the well, instead of giving us 10 million cubic feet, because there were some areas that were closed, so we took advantage to open up some of these areas, we got 35 million cubic feet of gas instead of 10 million a day. That gave us 35 BCF of gas. That's 35 billion cubic feet of gas out of one well. To put it in very simple terms and number, when you drill this kind of well, one well, this well is going to be produced at about 20 million cubic feet of gas a day. We get paid $5.08 per million BTUs. Our cost of producing this well is about $1.50. It's $1.50, 55, but it's $1.50 right now. Depends what the pesos is, because we're also in pesos. So $1.50. So our net back on this thing is $3.50 before royalty and before taxes.
Okay. So Serafino, my hand is not working with the I can't do the math here. How much is this going to make a day for you?
This thing's going to make about $90,000 a day.
Okay, $90,000. Okay, so times 30 days, you got almost 2.5 million a year.
Well, it's more like 35 million. It's more like $35 million a year.
Yeah, 2.5 million a month roughly. So
yeah.
It's okay. So and that's profit basically. That's the net.
Yeah, and that's one well.
Okay. So we got 35 million a year. Basically, this is to the bottom line.
Correct.
Okay.
Before taxes and before royalty.
Okay, and the G&A, yeah. Right?
G&A is very small. We're a very lean and mean organization. Our G&A is less than $1 million a year.
Okay. So 35 million. That's one well. Yeah. What else do you have?
Well, we're going to be drilling 6 wells out of this thing. Potentially, what we have in resources, what they call P50, it's between 100 and 200 billion BCFs of gas, billion cubic feet of gas. That is a 15-year potential producer, 15 to 20-year potential producer, giving you revenues of about $70 million a year.
Okay.
Out of the field.
Okay. So 70. Okay. So in total, so you got the first. Okay. So the first one, there's some Maria Conchita that's going into production now, right?
Well, Maria Conchita is going to go. It did one well, the Arruchara.
Okay.
Next week, we start drilling a second well that is called Istanbul. The Istanbul well gave us gas. At the end of September, we're going to drill the third well. That's going to take our production from 20 million cubic feet of gas a day to 35 million cubic feet of gas a day, which means that our revenue will go up to that point. And as we go to the following year, we're going to take the production, the optimal way to take out this natural gas is somewhere around 40, 50 million cubic feet of gas a day. So
Okay.
what does it mean for us?
Yeah.
This is our cost of producing, it's very little. Our lifting cost is 25 to 30 cents per million BTU. The rest is transport. It's sales contracts that you got to have with the distributor of the gas. But the reality of our project is that in Maria Conchita, all the gas that I produce, I can sell it tomorrow. I can pre-sell it for the next 20 years without any problem. And the people that are buying the gas from us are major producers of electricity and major buyer gas and blue chip companies. One, it's called Electricity of Medellin, which is the second largest company in the country. The other is electricity of Unión Fenosa, which is a fantastic, it's owned by NL Power, so it's a big company.
Okay. Okay. So this is pretty impressive. Okay, you're gonna in terms of run rate, you're gonna exit 2021 with what kind of run rate? Assuming everything gets into
2021 is going to be only 6 months. Okay, we're probably going to start doing about 12 to 15 million this year.
Okay.
In revenues. Now we have all the infrastructure financed. The well has been financed. The second well's got fully financed. We just raised $9 million. That's going to go mostly to develop the Sinu 9, which is the next concession that I want to talk to you about.
Okay. So yes, let's talk about that. Let's talk about the Tiburon project and all that.
Yeah, Tiburon is easy to talk about. It's a mega concession. Potentially has 2 to 3 TCFs, trillion cubic feet of gas, but it's an early exploration concession. It's got the right address. It sits in the right place. It's surrounded by 3 of the major gas discoveries in the northern part of South America. Perla, the 2 of the projects that belong to Ecopetrol and Exxon, Orca, that it's called Orca. These are 10 TCF to 20 TCFs of natural gas, so they're big monster. This is going to be a story for the next 2 years. Our big story is Maria Conchita and Sinu 9. Sinu 9, we're probably going to start drilling sometime around May. Now, Sinu 9 is a concession also that was drilled in the 1990s. Same kind of thing, discovery of natural gas. It sits right next to Canacol. Canacol is the largest producer right now, private producer of natural gas in the country. It produces 200 million cubic feet of gas a day. It's $1 billion company. We are literally share border of our deposit with theirs. It was drilled in the 90s. They found natural gas. It belonged to a Mexican group. I bought it from a Mexican group 5 years ago. It has now become the star. We've done a lot of work, a lot of studies, independent studies. Potentially, it's got a TCF of gas, between 700 million cubic feet of gas and a TCF of gas. That means that if we take it, we're going to be drilling 6 wells in the next 2 years. They're fully financed. Discovery rate, it's 99%. We already have a discovery, and we have a producing well that is capped.
So this is basically, it's like a done deal. So in other words, it's essentially at this point.
It's development. It's development.
Okay. Okay. Now this is very exciting. I kind of want to talk a little bit about, kind of your background, some of the key members of the team. I mean, you got Frank Giustra, who's a big investor. You got you've had your chairman. You guys have had some major winners in the energy space. So tell us a little bit about your background.
Well, my background is in oil and in mining, mostly mining and then oil. And as I got older, we've been involved in the mining business for 40 years. I know Frank that long, believe it or not, since the 1980s. We've done many businesses and developed many projects in the past. It is, as far as oil, that we want to talk about oil, I was the founder and developer of one of the major oil companies in Colombia, which was Pacific Rubiales. I founded that company with $35 million in investments. We took it to be a $14 billion company. A lot of people, a lot of our investors made money. Stock went from 35 cents over 3 years to $27, $29, I think was the highest that it went per share. Paid $7 billion worth of dividends over 5 years. And it was a success story. Unfortunately, it went through a bad time when oil prices went down to $25, like many companies went through suffering. But right now it's still a live company. It's called Frontera Energy, and it's, you know, it still produces oil. Not as much as we used to.
Okay, but Serafino, the main thing is this. Here's I think the key takeaway. Okay, so you know, I always believe that, you know, these things, like, it's very important. Hey, if somebody did it once before, they could do it again. So if you had something that went from, you know, 35 cents, right? It's
Yep.
the stock started at 35 cents, it went to $27 in 3 years. You know, that's actually, this is what we're looking for in our program. This is our motto: 100 baggers.
Well, it's, look,
You
all
almost
these projects.
So this one you got to do. The GASX has to be the 100 bagger now.
Well, GASX, the company, Maria Conchita is the company cash flow. Sinu 9 is the 100 bagger that you're talking about. Sinu 9 is going to take us to 200 million cubic feet of gas a day, which, when you look at it, at $5, that's $1 million a day in revenue. Okay, it's $1 million a day.
300 million. So basically, $365 million dollars a year.
Yeah.
Right? How much of that to the bottom?
Bottom. I'm talking about bottom, because
Bottom
the cost
line.
of producing, cost of taking out the cost of producing. The gas in that area sells at about $7. I urge your subscribers to look at a company called Canacol, which I'm very impressed. It's an impressive company. They were the first one that started understanding that natural gas was going to be the key in the markets. And they were a company that they had $150 million market cap 5 years ago to $1 billion these days. And their revenue is exactly that, about $350, $400 million a year right now. We're going to be a carbon copy of that company.
Okay. Okay. So that's very important. You basically have like a model to duplicate, to copy.
It's people that look at our website, they're going to see, the first thing they're going to see, that we're right next to Canacol. And we're in the upper side of the structure, so we're going to have the same kind of life.
Okay. What's the market cap right now of NG? How many shares are fully diluted?
It's about 110 million shares. Market cap, it's about 160 million. We have about 15 million in cash. Our G&A is very, very small. We're a lean, mean organization. We have 6 people working for us.
Okay.
And we run everything.
That's pretty lean and mean for an energy company.
Well, it's because the world has changed, and the way you got to do things right now, instead of me having 6 geologists or engineers, I'd rather have a couple of key people in my organization. And if I need somebody to do work, I hire them. I let them do the work, and see you next time. That's the way you got to run company. At this point, look, one of the things that I was telling you before, in life, you got to have 2 things. And I always say this because it's my motto: know how and know who. The know-how is the most important thing, but the know-who is just as important. So you got to have the know-how, because you got to know how to spend your money, how to control your money, and how to know that you're working for shareholders, and you got to make money for shareholders. The know-who is important in countries, especially when you work in Latin America. You don't see me do business in Africa or Asia or Australia. I do businesses in country where I have the know-how and the know-who. So Colombia, I live there, I work there. That's where I do my business. That's where my family is, and that's where I go. And every single morning I get up and I know what's going on internally, politically, and internally that makes my company more efficient. And I don't run my companies out of Vancouver or out of Australia. And nothing wrong with doing that, by the way. But that's not my style.
I mean, you're on the ground, basically.
Always.
Well, okay. This is a real operation. Okay, pretty impressive. Okay, so essentially you got 150 million market cap approximately. What's going to be the path for this to be, let's call it for now, just for now, a 10x, 10 bagger? What needs to happen in the next, is there a runway?
What needs to happen is you're going to see some paths in going around. I'm going to stop for a second, please, because I'm going to run out of battery, and that's
okay. We're looking at this. You're painting.
I apologize.
No, it'll give us a better view of the Botero.
Hold on a second, bud. Here we go. I apologize, but this modern technology.
This is part. This is part of why people tune in. They're tuning in for the entertainment, also. It's part of the.
It's part of the entertainment, no?
You never know what happens when it's live. Okay, so just if you could, just the cap, just a little bit up, like that. Okay.
I apologize.
Okay.
But it's either that or I ran out of battery.
Okay. So now
you were asking me what's going to be the things that are going to change everything.
What's the path? What's the path for this?
The path is very
$10
simple.
stock, $15.
Production, cash flow. And what is my goal of this company? This company in 2 years, I want it to be a dividend producing company. This company's got to pay a dividend because we're going to make a lot of cash. So the next 3 steps that market has to look at. Number one, we're going to be drilling the Istanbul well. Istanbul potentially could give us the same surprise that we had in the Arrochara well, where we're going to be producing 20 million cubic feet of gas a day. So path number one, we're going to drill that well, which is going to increase reserves. Path number 2, we're building the infrastructure, which is a 14-kilometer pipeline, and the infrastructure to hook up and start producing the gas. You got to clean the gas. You got to take out the liquids and so on. So that's going to be done in the next 60 days. We're fully financed. We don't need any money from anybody to do that. After that, we're going to start producing. And as soon as we start drilling Sinu 9, watch out, because the moment that we hit Sinu 9, it's all over. Sinu 9 is going to be the company maker. And that's going to make this company not a little junior startup company. It's going to make us into a mid-sized producer of natural gas. It's going to make us the second largest producer in Colombia.
And when does that go into production? The Sinu 9 again?
Sinu 9, we're going to drill it in April.
Okay, and production when?
Production probably by the end of, by the time we build the infrastructure and everything's going to be September.
Okay, but I think once the drilling starts, so it's underway, then the stock starts kind of reacting. People kind of anticipate the market more.
The stock reacted already from where it was. When I took over this company, the stock was trading at 16 cents a share. So it's at $1.60 now. And at $1.60, when you look at earning per share that we're going to have starting September of this year, once we start gearing up into receiving revenues, this company, what does a company like us trades? It should trade at least 7 times earnings. And that's going to be the reality of this company. And where we are right now, and that's just out of one well that it's ready to produce. The moment that we start building up infrastructure and wells, This thing, our goal is to become a 220 million cubic feet of gas a day producer.
Okay. Serafino, let's wrap up. Near-term milestones, let's call it next 60 days. What do you have coming up that investors can keep an eye on in terms of news flow?
It's gonna be Maria Conchita. Maria Conchita, in 2 weeks, you're gonna have the results of our second well that we're reopening and drilling, which is the Istanbul well. That's gonna give us production, and it's gonna increase the reserves of the concession. The other things is the assignment of rights to start drilling. That's the environmental permits to start drilling Sinu 9. And then everybody's got an eye on us because we are the only other concession left in that area, because outside of Canacol, the rest of the concession all belong to the National Oil Company besides ours.
Okay. So, Serafino, last question we always ask, on these programs. In your opinion, what are the top 3 reasons for investors to consider GASX today?
Well, I would start with the most important. If you look at the value compared to our peers, the same as we are at 10% what they are in value. And like I said, I urge people to look at a company like Canacol, which is, I think, a very close relative of what we are going to be in the next 12 months. The other reason is we are in the right neighborhood where they pay a premium for natural gas and where there's going to be a shortage of natural gas. So natural gas, if you take the 10-year history of natural gas in Colombia, natural gas has been always between $4.50 and $8 per million BTUs, always. There's always been a premium. And I think that premium is going to stay and it's going to increase. And I think the third most important reason is that we are going to become very soon a neutral, a country that is going to be CO2 neutral, because what we produce with the natural gas that we produce, our emission is almost zero. And all the programs that we're putting together, it is very easy to become CO2 neutral.
Okay. Serafino, on that note, I want to thank you. We look forward to having you back in maybe about a week or so. We're going to go through the whole slideshow, an update, when the wells and everything else. We look forward to following the company, hopefully on this journey to this 100X like your last one.
Well, thank you very much. I'm sorry about the running around and putting battery.
It's a value add. That's part of the value. That's part of, people.
Thank you very much for your time.
Thank you, Serafino.
Take care.
Okay, wow, exciting stuff here. Let's get ready for Skylight. Okay, just 1 second. Let me get things set up. Okay. All we know is Prad.
Hey, how are you, Jack?
Fantastic. How are you doing?
Doing well.
Things set up here. I just want. Can you actually? No, your camera's just maybe a little bit lower. Just a little bit.
A little bit lower. All right.
A quarter of an inch. Just a little more view in there. Okay.
Is that good?
Okay. Yeah. Perfect. And I think I'm getting. Is there something open here? I'm getting a little bit of feedback.
Let me move the phone away again. Maybe that's
the speakers and the volume.
Is that better?
Yeah. I think it's good. Okay. And are you going to show us a couple slides today? You want to just get that ready?
You put it up? Yeah, sure.
Okay. Yeah, the sound is a little bit. I don't know if it's mine. I think it could be mine. I don't know, but we'll deal with it.
Okay.
It's a little tinny. It's a little bit. Okay, let's get that ready. Okay, so I want to have. Okay, and if you just do the. Okay, okay. You're gonna show that later, right? Because there's something you want to show us, right?
Yeah, I'm going to walk you through this. I think this is really interesting, Jack. This was actually put together by one of our banking partners in the US.
So we're gonna talk about that because this is we're talking about the CF. I said, wow, this is pretty impressive. Like the kind of feedback that you're getting, from the analysts, the bankers. I mean, right now you're really kind of who you dealing with? Who? Oppenheimer, Raymond James. Who else is in there?
People.
I mean, it's like the who's who. I mean, next thing you know, it'll be Goldman Sachs.
Yeah. Well, we actually met with on some of the institutional rounds. We met with Goldman Sachs and J.P. Morgan and some of the big accounts, Lazard Financial. So it's been great. It's been an educational and learning experience. Some of these accounts ask really good questions. They're knowledgeable, very, very smart in the space.
Okay, perfect. So we're set up. All right, so let me do a quick intro and then we'll get right into it. We got a lot of people who are excited. Welcome everybody to Wall Street Reporter's next Superstock live stream from March 4th, 2021. We are back with Skylight Health, SHGFF, Prad Shekar. This is a stock that's has been starting to make a massive move. We're looking to see if this is going to be our next 10 bagger. We've had already this month two 10xers, one 50x since December. So Prad, you need to catch up right now.
Oh, we got lots to go. There is lots on the come. That's for sure.
We need to see the last guy, the guy we had before. He had 100 bagger stock in the energy space.
All right, challenge accepted.
I like this. This is it. So we need 100x Skylight Health. So let's talk about how we're going to get there. Let's talk about 10x for now, just because that's the appetizer. So what's going to make this a $15 stock? US. You got some news you released this morning. The market, the Nasdaq has taken a big hit, last couple of days, so the market's not really paying attention. But otherwise, it would have been we would have massive launch. So explain this deal, the latest acquisition you announced today.
Yeah. So this is funny because everyone knows we're working on closing the sixth acquisition, which, when you deal with more institutional sellers, you deal with more institutional lawyers, and it just takes longer to finesse every word. I've never seen grammar get to such a level of detail as I have in this negotiation, but it's all positive. It's all good stuff. It's moving forward. But yeah, look, I mean, the reality, Jack, is we were trying to time things to close after, and announce after, but the pipeline's just getting too full. So we just got to start coming out with some deals now. So, these three we kind of, grouped together and put out because quite honestly, we got to get moving on them. There's more coming in and we just can't sit on too much in the pipeline. So it's not a bad problem to have. But yeah, so certainly exciting.
You had a quality problem, actually. It's a quality problem. A lot of companies wish they had problems like you.
Yeah, sure.
You got 10 million. You're going to add 10 million. This is another 10 million you're adding to.
Yeah, and again, this isn't even taking a dent out of that 100+ million pipeline, right? So we still have a lot more we're working on, and as they keep coming, it's just uncovering more and more. In fact, just this week alone, we've had 2 inbounds reach out to us after announcements we've made in markets now saying, hey, would you consider us? And so the market's opening up. What people need to just, what I just keep reiterating and what people need to look at the market size here, right? We're talking about, 500,000 practices out there today, out of which over 400,000 of them fall under 10 million in revenue. These are small to independent physician practice offices. There are more deals that are possibly out there today than, 10 Skylight Healths could try and ingest. And the reality is we're going to just continue to be so busy because there's so many opportunities out there. And this whole, that shift to, a better infrastructured organization to meet the demands of the growing healthcare industry in the US, it's consolidation with primary care practices. It's happening. It's not, can it happen? Will it happen? Is everyone going to want it? It's happening because the pressure is squeezing the small guys out. And so, Skylight Health is there to provide a better opportunity for these practices to join with than what they have today in the market. And it's showing. We're seeing a ton of deal opportunities, and we're staying super disciplined. I mean, look, we're 3 to 5 times EBITDA. We've been like that since the start of all our acquisitions. We're proving to the market that there's no, value contraction here. There's no paying up for deals, and what U.S. investors are loving about the story is it's not just an M&A story. It's It's how you're going to take these clinics and transform them 500 to 1,000%, by being able to bring them to the future capability of playing in that healthcare space, right? Where guys today are paying like 14, 15 times EBITDA for the same transactions. So there's a huge upside, and that alone is just reflective. But yeah, these three deals, Jack, right up the sweet spot of what we look for: primary care, massive opportunity for short-term growth, and ton of opportunity for long-term organic growth.
Okay, so I'm getting like a couple takeaways. Number one is, which we've talked about before, is you have this massive consolidation opportunity in U.S. healthcare. This is like, you kind of one of these classic, consolidation roll-up opportunities out there. You're making it happen. But what's more important is kind of like your value add. The reason you're not just doing a roll-up, you're not just buying a bunch of things and, putting them together. So you're really creating a value where you're able to, with your model, increase those revenues post-acquisition by 5x, 10x, basically. Is that correct?
Yeah, and even more, right? So, on a fee-for-service model, which is how, majority of primary care practices work today, right? On a fee-for-service model, which is you go in, doctor gets paid, payer pays the doctor, right? The average revenue of these clinics is about $150 per year, which is about one visit per year, right? On average, patients should be coming in 3 to 4 times a year. So to bring that practice from 150 to potentially, improved revenue through improved visitation, frequency, access, telemedicine, things of that nature, you're right. That gets that 2 to 3 to 4x return on that practice, right? But the way the healthcare market is moving is insurance companies are actually saying, hey, physicians, we want to stop paying you on every encounter. We actually want to pay you a fixed amount per month per patient, because if we pay you to do a better job with your patient, then we're paying less money out on the more expensive surgeries and emergency room visits. And we're not talking about a small capitation fee. Like in Canada, capitation fees are like $200 a year, $300 a year.
What's a capitation? What is that? What capitation is?
That's like me saying, rather than paying you every time the patient comes, I'm just going to pay you a fixed amount per patient per month. It's like subscription revenue. It's very similar.
SaaS model, which
exactly. Yeah.
Loves.
But we're talking like $400 to $1,000 per patient per month, right? That's $6,000 to $12,000 per year. So you're talking about clinics today that are doing about $150 a year, with the potential of going to $6,000 to $12,000 per year per patient, right? Just to break that down, if you even look at the patients we have, right? So let's say 20% of our patients, which is on average Medicare patients, right? Senior populations. If they were to subscribe to a Medicare Advantage product, on average, a Medicare Advantage product is about $1,000 per patient per year. We're talking about, call it $4.5 million on our 20% of that patient base today, to over $300 million on that exact same patient base in a managed care product from Medicare. That growth, right? That organic growth happens because of what we're able to bring to these practices in terms of infrastructure and scalability.
Okay, so you're saying based on what you have right now, you're saying you can do 300 million revenues.
Based on what we have today and the capabilities we're building towards, that's just the minimum. I'm only talking about 20% of the patients. I'm not even talking about the other patients that could benefit from other kinds of value-based contracts.
Okay.
Value-based contracts is what we want. That's what is ultimately leading to this per member per month subscription style model.
Okay, so it's very interesting. You have this. It's kind of like this arbitrage opportunity here. So right now, I mean, with what you have, built in to your model, baked in, sort of, and this is what you have right now is, that you're going to be able to ramp up these people into about 350 million revenues in the next. How long is it going to take you to get all the?
Every market's different. Every clinic's different. But let's say the next 12 to 24 months. I mean, look, you're talking about technology, data analytics, and payer contracts. They don't take long to put together, but you got to be able to put the foundation in place, right? Which is why you see that organic growth just by improving the practices. But that's not factoring in this massive increase in potential by switching to these value-based contracts. If I did nothing else, if Skylight Health did nothing else, Jack, we didn't buy any more practices, which, by the way, we almost have no choice, not to do that, because there's so many out there that are coming in, with this price point. But if let's just say we stopped M&A activity, right, the company would see, a significant growth on just revenue from existing platforms alone. That's why the story is resonating so well, because the M&A is a huge driver. A lot of companies do M&A, but it's the organic growth that is almost the icing on the cake that's coming for free, right? You're getting the value on the M&A, but the organic growth is free.
And also, I think we should emphasize that's really the organic, creating the value. That's the thing that investors are paying. I mean, institutions are paying for. That's the thing that they want. They want to see, okay, anybody can do a roll-up, okay, but who can they actually operate in? Can they, create value from it? That's the key thing. Okay, so
exactly.
Okay, so takeaway is based on, you got this 350 million plus, and you got this like growth on top of growth, basically.
Right. Right. So what you're going to see is you're going to see that 70 million, that $100 million exit potential this year, just on M&A alone, right? I mean, there are so many deals that we have to go through this year. One of the things we're working on internally right now is trying to drive up that capacity, right? We brought on senior executives. We're building out our corporate development team. We're building out our infrastructure and integration team, because we want to be able to keep up with this capacity this year and next year as we continue to grow. So you're just on that nature alone, you're going to see a huge trajectory of growth, because the market has so many opportunities for acquisitions within this price range that really nobody's focusing on. Everyone's focused on the higher value assets because they want to get there faster.
That's the other thing I want to emphasize. So what you're doing different is there's two things that Skylight is doing that's different. One is you got this organic growth model where you can really essentially increase the revenues by 10x of the clinics you buy. But number two is there's a lot of institutional players, not like the private equity players that are they're active in the space, but they're going after these kind of massive they're looking at these 100 million plus deals, 75, and they're paying. Let's talk about the difference between the multiple they're paying and what you're paying, and kind of.
Can I show you my screen? Can I show it? I want to show it to you because I actually think it's on paper, so it's not just me saying it. So
Can you show just go to the main slide, like just so it shows one at a time view, I guess?
Yeah. So I want to just thank obviously our team at Oppenheimer, our U.S. banking partner that put this together for us, because this is obviously something that we've seen from feedback and something that they were very excited and why they're excited. So first of all, here's where I'm going to show you right here. Sorry if I'm looking down, if I'm looking at the screen.
Can you show just the main slide, just the big view, the big.
Can you not see the screen?
I see it by if you can just make it the view so it's one slide at a time. Right now I'm seeing on the sidebar, I see the what do you call it?
Oh, you're doing
yeah, it's going to make it bigger. If you just close those out, it'll make it.
I don't know why it's showing you my other screen, to be honest with you. I think it's something on the screen sharing, Jack.
Okay. So
I'll tell you what. I'll make this smaller here so that you can see this better. Is that okay?
Yeah. And if you can, is it possible to make this bigger now? Expand it? No, okay, that's it. Well, okay, yeah.
Is that better?
Yeah. Okay, good.
Okay. It switches otherwise. Okay. So look, this is not just us saying this, right? Look at the average per member per month rate on a Medicare Advantage plan, $968 per month, right? That's per month, not per year. Medicaid Advantage, $410, right? So you're talking about $6,000 to $12,000 per year just on sort of Medicaid alone. So to your question, Jack, here, look at this. Look at the median EBITDA range that companies are paying for right now on the U.S. Private equity companies, mind you, and some public, soon to be public companies like Cano Health. Right, 14.7 times EBITDA is what they're paying for practice groups on the U.S. Now, these are large transactions, right? I mean, they're not small, but if you look at smaller transactions like 60 million, right? Look at their multiples. Look at this one here: 60 million in revenue, 7 million EBITDA, 13.5 times. In the last 3 years, the median price paid for practices has gone from 9.5 times to 12.3 times, and it's only going up, right? And the reason for that is because they're all buying these already converted clinics that are already doing this value-based per member per month subscription model. What Skylight's doing is we're not paying the 12 to 14 times. We're not going where it's crowded and expensive. We're going to this bigger green space where more practices exist, and we're paying a discount. We're paying 3 to 5 times. But these clinics haven't converted yet. So we're converting them. And in converting them, our shareholders get 100% of that result organically. They're not paying for that. So you're getting a fast way to acquire a patient base rather than opening up organically, right? So what Oak Street Health did, right, just on this slide here, so they're de novo. They only open up organically, but it takes them 0 to 2 years to build a patient panel, a full patient load, right? So what Skylight's doing is we're basically building it instantly because we're acquiring these practices that are already full of patients. And then we're just putting in the infrastructure and we're converting them. And in converting them, you're getting to that 500 to 1,000% growth because you're going from $150 a year to $6,000 to $12,000 a year. And by the way, the patients are benefiting from this too because there's far more that comes to them with this program. This is the way the U.S. market is moving towards. All the payers, all the big payers, Aetna, Optum, Humana, they're all shifting to trying to get physicians to go under this kind of subscription contract basis. The problem is most of the physicians aren't able to because they don't have the capability and technology. Exactly where we play, right? We're going to most of them and converting them. So again, this goes back to why our multiples are so attractive, because we're playing in a place that, quite frankly, everyone doesn't have the patience to get to themselves, but we get the benefit of doing it.
Okay, so it's very, it's like everything is it's like the stars are perfectly aligned. Like you're in the right place, right time. You get massive market opportunity. You're able to create this value. You get this like arbitrage opportunity. You're paying, 3 to 5x, and it's worth 12 to 14x based on the pure comps.
But even the better part though, Jack, and sorry, not to keep cutting you out, I'm sorry, but you're right, is, it's not the EBITDA multiple that these guys are selling or buying at. It's the revenue multiple that the analysts are giving the companies that are driving organic growth. So on that slide, I got 2 companies, I got Cano Health and Oak Street Health, right? If I got a second to show that again, right? Okay, look at Cano and look at Oak Street. So Cano just merged with a SPAC and they're going to go public, right? Both companies are almost the same size, right? Similar locations, similar number of patients, similar kind of revenue, but look at the profit. Oak Street's losing money and Cano's making money, but look at the enterprise value. Oak Street trades at a 13 times revenue multiple, and Cano trades at a single-digit EBITDA multiple. The reason is because analysts are saying, hey, Cano, you're going and buying these existing converted practices for higher and higher prices, but you're not able to get organic growth. Why? Because they're probably already converted. Versus Oak Street, you're doing it organically. So we're going to give you the revenue multiple because you have organic growth. And what the bankers are saying and what the market is telling Skylight as we continue to market down there is, Skylight, you're going to see a revenue multiple because it's not that you're buying practices like Cano, it's that you're driving that organic conversion over yourself. And that organic conversion is ultimately what's going to result in you getting a multiple on revenue as opposed to a multiple on EBITDA. So the arbitrage is significantly greater as a result of that. And so there's sort of 2 factors here, right? Strong fundamental growth, but also strong shareholder value return as we get the revenue multiple, not the EBITDA multiple.
Okay. So and just okay. So for anybody doing the math, the difference between the EBITDA multiple and the revenue multiple is how much? So let's say if you're getting the EBITDA multiple, it's only 12x. But if you're doing the revenue multiple, then is it 100? I mean, it's wait.
Yeah. Well, first of all, Oak Street's not even profitable. So, for them to even get that multiple without any profits is pretty phenomenal. I mean, look, from our perspective, you're talking, it's 40, 50 times as opposed to 12 to 14 times that these companies are selling for, right? And we're buying them at 3 to 5 times. And by the time we convert them and you look back, we probably only paid about 1 or 2 times.
You know what? Let's make it simpler. Just make it simple for anybody to follow along, right? When you make an acquisition, let's say you're picking up $1 million in revenues, how much should that $1 million in revenues be valued at by the market by the time you're, if this model works? How much is that worth?
Well, let's say we buy a practice and the practice is doing $1 million.
Yeah. And
so let's say short term, we institutionalize that practice, we make it more efficient. That $1 million can become 1.5, 2 million, 2.5 million. Okay, let's just say 2 million.
Sure.
In that 2 million, there's about maybe 25 to 30% of people that should be generating, let's call it $8 or $10 million on their own. And so that $1 or $2 million can become $10 million organically by converting them into those value-based contracts. Your multiple on that should be, if you're Oak Street Health today, 13 times.
Okay. So basically, so that's $130 million.
Right. And what you paid for that is probably 1 times.
Okay. Wait, so you paid let's call it $5 million for that $1 million.
No, they're only generating $1 million. When I bought them, I probably only paid about $800,000 for it.
Oh shit! Wow. Wait.
I pay on average less than 1 times revenue, maybe sometimes right at 1 times revenue.
No, I get your EBITDA. we get okay. So here's the arbitrage opportunity gets even better. Okay, bottom line. Tell me because I failed math. You're picking up an acquisition.
Science guy, don't ask me math questions. Anyways, go ahead. Yeah.
$1 million, right? The thing is $1 million. The market values it at $130 million. So for every million you pick up, at some point, it's going to be worth $130 million in market cap. So
exactly.
So acquisition, you picked up $10 million in revenues. In theory, if everything works, the model works, that's going to add $1.3 billion value of Skylight.
Yeah. I mean, look, Skylight, just even work it backwards for you, Jack. Look at Skylight today. Skylight has about 160,000 patients, right? And our revenues are $56 million on an annualized revenue. Actually, that's not even including the new ones that are coming in. Let's just say near 200,000 patients generating about 56 million because they're all fee for service. They're all in that lower end scheme. Now, if you look at Oak Street Health, they have 97,000 members and they're generating 1.3 billion in revenue. So you can see how that natural evolution to the future healthcare models, which by the way, all the payers are going to, is going to result in an 8 to 10x or 5 to 10x return on increase in revenue from what you're making today. And a multiple on revenue on that is, I mean, now my math doesn't.
Okay, so right now you're basically at a run rate. Once this deal closes, you're going to be at a run rate of how much?
56 million.
56 million.
On an as-is basis today.
Okay. So in theory, you know, when your program kicks in, when your model starts kicking in at its full, you know, at max, and the market is cooperating, that's one thing. This is two parts. There's your part, and then the market has to cooperate in terms of valuation multiples, right? If those two things are working, that 56 million should be worth 130x. What is that? That's 10 billion, 8 billion value?
Yeah, that 56 million in revenue has the potential to become 400 to 500 million in revenue. Okay. Once all those things go into place.
So it's roughly right now, in other words, like essentially it's like Skylight essentially is already, it's an acorn, but the acorn already has the oak tree built into it. It just has to come out. So in theory, you really have $5 billion. Like right now, the company's worth $5 billion. It just has to come out.
If we did nothing else but just focus on organic growth, which by the way, analysts in the U.S. are rewarding organic growth more than M&A. So if literally all we did was organic growth, that multiple could be even better.
How many shares are at now fully? Like after everything is, you know, with new acquisition and everything. What are we at right now? Like today?
175 million.
Okay, so what is that, about less than 200 million market cap right now?
Right now on the U.S. side, yeah. On the Canadian side, it's about 220, 230.
Okay, so 200 million. Let's just call it 200 million. So basically, just on what you have now, let's say you did nothing else, this should be worth 25x. You know, one thing is coming to when they mature, and let's call it 12 months. By the time the model kicks in, everything else.
Right. So there's your growth rate.
At the same time, you're not stopping, right? You're not. This is
I can't stop, but there's so many deals in the pipe. I can't stop. We have to keep going.
This is the model. This is sort of like a fast car on a fast train. This is the model. Or as what is a rap song? Racks on racks? Is that the thing?
Racks, yeah.
You know, this is so. This is incredible stuff. All right. We got the model. I don't know. This is to me, it seems like a no-brainer. I don't know why the stock is not trading at $5 right now. It doesn't make it makes no sense to me.
You know what? Market's the market, but I'm telling you, the interest we're getting, and honestly, why I think we believe we see so much participation from, the likes of top-tier banks wanting to work with the company, because Skylight's carving a niche. Really, it's carving a niche in a market today where everyone's focused on one, shining light and object and chasing that and paying high prices for it. And we're going to get to the same destination. We're just doing it in a very unique, different way.
Let's jump to a couple of questions, and then we'll kind of wrap up in a few minutes. Okay, so Morpheus asking, have there been empirical studies showing how much Medicare would save on more expensive surgical care in emergency room visits? I guess on the spending the subscription model, I guess, if they had your subscription model.
There are stats. I don't have that on the top of my head right now to say, but what I can say is, primary care, I think one of these stats that came up, primary care probably represents less than 10% of the total healthcare spend in the US being multi-trillion, right? But controls over 60% of the costs associated with healthcare. So just to play that in comparison, the revenue paid to primary care is less than 10%, but the cost impacted to the healthcare system is more than 60%. So it's a very important area, which is why we're seeing more money from payers to primary care, because it's going to relieve the cost downstream.
Okay. I think, Pratt, I think the big takeaway, which you've never mentioned this before, but basically the model is this. I mean, for investors, the model is, here's what they need to look at. There's only one thing they need to look at right now, is for every acquisition you make, for every $1 million in revenue that you bring on, at some point, the market is going to value that by this 130x,
right.
Assuming the organic kicks in,
the
valuations. But so basically, it's 130x. So if you pick up another $50 million in I don't know, in the next couple of months, that's $5 billion. So like the company in theory could be $10 billion valuation in the next 18 months, and it's kind of baked in. So in other words, the acorn is there, the oak tree is going to come out of it.
Yeah, and again, I don't think that's hard. Look at Oak Street today; they're valued at over $10 billion market cap today, and they only have 97,000 members. Skylight's members base is bigger, but not billed under that same contract model. And it's not like we can't. We're the ones bringing those patients to that contract model. So at some point they will be. And that point is where our revenues could potentially even outpace some of these existing players in the market.
Okay, so you could outpace an Oak.
Yeah, don't go tell them that. But look, everyone's got to have. We have a long line and a long drive to get to where we go, and this is why we're so excited, because it's not about beating out one player or another. It's about literally taking a big chunk out of a large market. That's it. There's enough room for everybody, but that chunk can be large.
Great question here. This is kind of where I want to kind of wrap up with this here. How many acquisitions are in the pipeline that have the potential of being converted into this model here?
That's a great question. So every acquisition. So the way primary care has worked on average with everyone we've done, right? We've announced 6, closed 5. Well, announced now 9, closed 5. Is about 20% of patients within each of these practices are senior patients, which they're all Medicare, and almost none of them are on a Medicare Advantage plan. They're all on just your traditional fee-for-service Medicare. So every practice we acquire has an immediate potential base that can go into a Medicare Advantage plan, but they need to have that infrastructure before you can do that. And so there's already a captive audience, and that's what's so exciting about this. We're purchasing a business where you have not just an active patient base, but a captive patient base that is already, within the confines of parameters to fall into that model.
All the stuff is already built into what you're doing. So it's like it's like a done deal. It's a fait accompli. Essentially, this is going to happen.
It's just about laying the infrastructure and contracting with the payers. That's it. It's the two things, which we're already contracted with. You're just changing the contract from fee for service to managed care.
This is it's incredible. Okay, so bottom line is the market needs to understand every million equals 130 million down. It's like okay. What do we have in the pipeline right now? How much do you have in the pipeline right now? You're 56 million run rate.
Over 100. Yeah.
What's
Over 100 million.
Over 100 million. Okay.
Yeah.
And over 100 million is in the pipeline. The last time we had you on, you said you want to exit 2021 with 100 million revenues plus.
That's still our goal.
Okay. Can you exceed that? Is it possible that you might?
There's enough deals, Jack. I mean, look, if one person was to ask me,
close. I mean, you're pretty close right now, 56, and we're only in March. We're only, what are we in March?
I know.
First week of March.
I want look. We're not going to stop at 100. So if we get to 100, we're not going to be like, oh, okay, we hit our target. That's done. No, it's the reason we're having to announce ahead of other closings is because honestly, there's enough coming in, and the team is pushing. We got to keep moving. So demand's just going to keep growing, and we're just going to have to continue to build the infrastructure so we can keep up the pace.
Wow, this 130x is an incredible number. Okay, Brad, last question here is what's in the pipeline right now? What else do you have? What kind of news flow should we be looking at? Acquisitions, what do you have in the next couple of weeks?
So we're working on closing, obviously, the larger acquisition that we announced, so that should be coming up shortly. We do have these deals that will go through, and again, so these three will set to close by the end of April. There's more marketing. I believe we're going to be presenting at a few more healthcare conferences on the U.S. side. We'll update shareholders, of course, as we go through the NASDAQ application process. We're also looking at some pretty impressive additions to our board as well. So that'll be something that comes in as well. And then, look, keep like I said, it wasn't long before we had to come with the next wave of acquisitions. These three are just the start of that wave. So Q2 hasn't started yet. I was kind of hoping for Q2 to kick in to start the next wave to give my team a little time, but it doesn't look like we have that choice. So we're going to, continue to make some announcements as we keep going.
Okay, Prad, on that note, I want to thank you, and I want to have you back on for the next acquisition so we could get to this, this thing over here at the bottom of the screen.
There you go. All right. Thanks, Jack. It's always a pleasure.
Thank you again. All right. So many potential 100 baggers in the pipeline here. We got, all right, let's get ready for AIML. Let me just pull up, let me just get this thing set up for you. 1 second. A little quick setup. Okay, and one more. Stand by. Okay, let's get Randy here. Randy.
Hi there.
How you doing?
I'm doing really good. I'm really good, thanks.
Fantastic. Okay, let's get everything going. So we're gonna do the slides today, right? We're gonna show the full deck, give people the full story, right?
Sure. So I'm set to do any number of things, but I can do the presentation.
We're gonna have some audience Q&A. So you want to do a quick screen share? Press the share button to get those.
All right. So there we go, and just get the slides up here. Perfect. Okay. There we go. All right, so can you see the screen?
Okay, I see. Yeah, okay. And I just want to do showing the main slide, the one at a time, I guess.
Yeah, that would be that'd be fine. So right here. So yeah, I can go right from the beginning if you like.
Okay. Yeah, let me do a quick intro. Yeah, I want to do a quick intro. Then you run through the slides. We'll go to Q&A because I want to have this. We're going to use this for our the big marketing we're going to start doing next week.
Sure. So, all right.
Hopefully the market cooperates. All right, welcome everybody to Wall Street Reporters Investors Discovery Day live stream. We're back with AIML Innovation, CSE. AIML is the symbol. We got Randy Duguay, the CEO. Randy, welcome back.
Nice to be here.
All right, Randy. So let's kind of before we get into the slides, which I want to get into. For anybody to give us a quick snapshot of what is AIML doing? What's the big market opportunity that you're serving?
Yeah. So AIML, again, listed on the Canadian Stock Exchange. We're focusing on digital health and new innovations, in particular around wearable tech, new physiological sensor solutions, and that also includes applied artificial intelligence and machine learning tools. And the history, a recent history of these solutions has been pretty disaggregated. Lots of people doing data aggregation, but we're doing a full end-to-end solution that really brings out the opportunity to help people understand how their behaviors relate to health using machine intelligence solutions. So that is a significant new trend and opportunity that people are really interested in.
The machine learning, that's the big part of your program, essentially.
Absolutely. And you need to have a whole bunch of key competencies as well as an understanding of many different aspects of the technological supply chain and stack. So that's what we've built as a team, as well as building significant channel connections to really expand our programs here.
How big? So what's the size of the market opportunity? Like realistically, like what are you going after? What kind of revenue could you be generating? When you start monetizing.
Right. So we're just in early stage of our commercialization entry, and so the opportunity is significant. When you put together the wearable tech and artificial intelligence machine learning tools, and you also draw in partnerships that provide for professional health services and supporting ongoing care, the market in these areas is over 200 billion. Now, of course, we're not going to secure all of that. It's a very it's a very hot space right now. But there's really not a large number of companies that know how to put all of these pieces together, and so we're really one of the leading companies. And
so
certainly,
200, Randy, you're going after a $200 billion market opportunity, basically. That's
the size of the overall market. Yeah,
200 billion. Okay, so hopefully you get 1% of that. All right, let's put up those slides. Let's get the slides on the screen, and then I'm gonna disappear. You're gonna do the slides. You're gonna explain how you're gonna get that 2 billion, and I'll be back for the Q&A. So let me just put this up, and
and tell me when you can see the screen, and when everyone's ready for me to roll. Should I roll? Hello.
Oh, I just okay. So you can't hear me when I'm okay. Yeah, you're ready to go. Okay, I'm gonna disappear. Okay.
Yeah. All right. So I just rolled now. Okay, great. So hi, I'm Randy Duguay. I'm the CEO of HealthGauge, an up-and-coming digital health company that's focusing on wearable tech, Internet of Things, and applied artificial intelligence-based solutions. And the world's really looking for new ways to address ongoing healthcare services. And so the global market opportunity is $245 billion annually, and we're really going to be serving that using a combination of our proprietary software solutions and technology. The core problem today is we see significant and rising costs in our health system. So there's been a lot of attention around acute care, episodic care, primary care, and of course those things will continue. But if we really reflect on the past year, the opportunities and the gaps that exist in our health systems in ongoing health monitoring and management that exists outside of the traditional health system, an ability to really tap into additional health resources in ongoing prevention, health services support, and addressing ongoing chronic conditions and management. Right now, core devices, a lot of the remote patient monitoring devices, they're good. a lot of people are really confused by them, and they don't really know what they're communicating to them, and they're not really tapping into the strengths and opportunities of the intelligence system. And so they're really limited in tracking and presentation and even interaction with healthcare providers. And so the underlying results are that people are still not really managing as well as they could, and how they're connecting with their care teams, which includes doctors, but also includes those other tertiary care providers. So, looking at one case example of heart disease, and there's a number of other areas that are important, but this is a really interesting area that affects so many different parts of our ongoing health needs. And so right now, 100 million people are affected in North America by heart disease. It's a silent killer. 1.5 billion people worldwide, and there's 400,000 deaths annually in the United States, which has a health systems cost of $50 billion. And that doesn't include the personal costs and implications of people that suffer through these diseases and the loss of life. So the silent killer, hypertension, is a precondition. And so things that we know, there's a tremendous amount of research and studies that show that when people have a current and ongoing understanding of their health status and how that health state relates to their behaviors, and they have an opportunity or an option to connect in with other care providers, they can and will improve. And right now, there's a lot of focus on things such as weight management, and we're seeing multi-billion-dollar companies just focusing on weight management. Our solution actually goes well beyond that, and I'll share with you a bit more about that example. And so the wrist, of course, is the most valuable piece of real estate in physiological monitoring, but it isn't the only thing. And so the underlying core asset is what we call a personal health management platform, personal health monitoring and management. And it's incredibly important to know how to capture high quality data. It's not good enough just to capture data from disparate sources. And frankly, many of the sources of physiological data monitoring are really not necessarily that trustworthy. And so there's still lots of room to improve on sensors technology, and we're going to continue to make investments there too, and working with manufacturing and development partners. But importantly, we are working with just a small number of devices where we can capture a high quality single contact electrocardiogram, digital pulse, activity, as well as new sensors that are coming into market. And we are refining these signals in creating for a blood pressure results using machine learning tools. So digital processing and how applied machine learning is being provided there is just one aspect. But just imagine the other output opportunities. Artificial intelligence covers a number of areas that you can also create additional value. So for example, you can use machine intelligence tools to actually have ongoing understanding and awareness of your current health state, and as we tag that or relate more behavioral information, we can have additional supports that the system is actually giving us additional input on health problems that are arising and interacting with our care providers much better than what's being done today, which is very rudimentary. And so even most of the systems that exist out there in these AI solutions are still very basic. They're contextualized just on one time. Our solution actually will maintain context understanding of the individual over time. So we're actually applying AI tools across the board in how the platform is being established. The solution, our solution includes a wearable that we can tap into Apple and Android-based OS. And so while we are marketing a risk-based wearable that's very specific to our requirements, we do see other leading device makers that we can actually put our application within. So we're not fixated on being a wearable tech or having the wearable tech as the end all and be all. Although it's very important to make sure that whatever devices we work with are capturing signals in a very specific and high quality way, because that's fundamental to the downstream quality of biometrics. And most of the manufacturers, and even the large manufacturers, are generally throwing out all of that rich information. We don't do that. So what we are strongly oriented towards the health and wellness, using high quality signals and processing those well beyond the standard. And so really setting the bar higher. And then on the far end, you'll see the online tools. And so of course we have an online interface that provides for different types of roles. So for end users, family and care providers, clinicians, and we also see a strong opportunity around researchers where new AI applications can be monetized that can be specific to different kinds of research, disease research and conditions research, and how that relates to behaviors. So there's not very many organizations out there that even can capture all of that quality data, never mind provide for AI-based tools to expand on it. So again, just a summary of what we're selling: a wrist and weight scale related devices that can provide for ongoing health management, software solutions that provide for a number of biometrics that are very important to elaborate on and to provide healthcare providers and family members and the individual a means of changing and modifying their activities to improve health and achieve positive health outcomes. And of course, the cloud-based infrastructure that's fully HIPAA compliant and secured, and that is going to be made available as a global solution. And we are able to tie that in with clinical systems such as electronic medical record systems and EHR systems. The validation work is ongoing, and what this is showing here on the left hand, what you're seeing is an example of the ECG and digital pulse, and the table, the graphic here is really showing that as we increase the number of paired data sets, we can drive the quality of blood pressure, and blood pressure being just one biometric of note, to really high quality and to be really comparable to off-the-shelf. Now, the thing, off-the-shelf blood pressure devices as example. Now, why this is an important thing to know is that the data that is available is not just the blood pressure. You can actually see what's called a QRST signal within the electrocardiogram, and we can start to make that data, when the individual consents and is getting benefit, make that data available to our partner organizations. And there's some really exciting partner organizations we're working with that are tying into clinical records of other ECG and doing other kinds of analyses. So by having a greater amount of signals and data, we can enhance that and enhance the value to end users further by working with our partners and creating value-add services within delivery organizations. One of the pictures I really like to elaborate on is we'll get into this table here in a second, but I really want to really draw your attention to the picture on the left. And what we're showing here again is just reinforcing this message that when people are motivated, we can discover and find those people that are motivated to reach and achieve positive health outcomes. Health Gauge is not per se just really about the technology. What we're really marketing and what we're really providing is, and I'll use the Uber, what I call the Uber metaphor, is we're providing a solution that is generally needs to be invisible to the end user. When you think about Uber as a concept and the digital health concept that I want to elaborate here is people are really looking to arrive at a destination, and digital health, the destination that they're looking to arrive at is a better health state future, and that can include how your body is addressing any kind of health condition, how you're interacting with care providers, the drivers of healthcare support and ongoing management. But for us to feel and get better, people are really buying the outcomes on solutions like ours. And what they expect is that the solution works consistently in a high quality way. And most of the digital health organizations are kind of in different starting points. They're an IoT or wearable company, data health aggregators, or virtual service companies that are doing telehealth and online connection and bookings, or AI companies, and of course digital mobile. People are not really interested in fundamentally in understanding all of the tech. What they're really interested in is that the system understands where they are, what they need in order to progress to an end state and outcome. And so we're building that end-to-end stack solution, and in making that easy for us to partner with organizations like the health coaching, kinesiologists, psychologists, dietitians, and doctors. So we're really making that system really invisible to the end user, and providing that end-to-end that really optimizes the flow of data, makes the system useful, and provides for deeper meaning in what's being provided as input between themselves and care providers. So again, the global digital health market is valued at $245 billion, and it's been growing annually at 39%. And it's really going to be populated by companies such as ours that are serving and building the channels to market that address that end-to-end stack solution I just shared with you. And the channel partner strategy, the individuals that we're interested in are those people that can be and want to be motivated to reach positive health outcomes, and to make our solution available through channel partners and working with channel partners in these three core areas, those being the payers and insurers that are providing services to employers and their employees, and helping them address ongoing health needs. The pharmacy organizations and pharmacy retailers that are providing value-add services in their communities, they are also continuing to expand down the path of monitoring solutions and relating that to and combining that with their services. And the medical services, the health service providers. And again, I highlight the CV-19 pandemic and kind of the gaps that are now being filled with companies that are providing for ongoing health management. And so in the United States, the accountable care organizations or primary care networks, and in organizations that are really providing ongoing health service needs. These are all channel partners, and we have a key B2B market approach with a number of these organizations here. And this is a bit of an elaboration again of that stack end-to-end solution. The people are again these end users, and what they are interested in is again being healthy and staying healthy, but working with their organizations that are serving their needs. So the health benefits providers, and that are keeping information or providing them with supports. And so we're really providing a core part of the overall solution in the channel partner strategy, And we're working with organizations that are providing the health coaching services or the other kinds of clinical grade solutions that we can provide additional support in our AI platform. And so we're selling this as a subscription service, and we're really going to keep the device costs low, in relating in similarity to the telecom or mobility market. Will provide an opportunity for people to upgrade their devices every 2 years, as well as continue to refine and improve on our overall service value chains on a subscription basis. Some of the organizations that they're really notable that we've been working with, the Bill and Melinda Gates Foundation on a use case serving pregnant women, and that was a really exciting project for us to show how you could put a monitoring solution in place to to serve women in a broad-based community, even in places where networking technology or networking infrastructure is light. You can still use solutions like ours to help in a care program. Revive Wellness in combination serving Alberta Blue Cross. And we're working on a program for addressing seniors, and Alberta Blue Cross serves all of Alberta as a case example, and again ongoing monitoring solution. The University of Alberta with MedRoad, and this is a new area that we're partnering in to address the creation establishment of virtual clinic solutions, and so we're really now bringing together our monitoring solution with other clinical or RPM type solutions in a virtual clinic settings, and we'll be building out on those solutions as we go forward. So R&D plans continuing to reinforce our AI through the use of supercomputing tools, because there's a lot of heavy lifting that goes on in how we can help both create individual plans and then plans for different health cohorts. Working with the Man-Machine Interface Lab on the introduction of new sensor solutions and software algorithms. Continuing to engage with healthcare and clinical researchers on their needs in expanding on the use cases of health conditions that people might want to be monitored, and again, just testing the latest generation sensors and therapeutic by partnering with organizations that have similar visions to ours. Our team is made up of very experienced people. Myself, I used to be an executive at TELUS Health Solutions, of Canada's leading digital health services provider and one of the first telecoms in the world to really create a full-blown digital health strategy and continue to expand on that. So I was one of the original management there to help establish what is today TELUS Health Solutions, continue to be very connected there and other places. And I've been involved in many multi-million-dollar product and commercialization initiatives, including ventures reviews and M&A activities. Bruce Matichuk, who has over 25 years in technology experience, and all of which has been not just basic software solutions and applications, but really fundamentally in artificial intelligence. And here in Canada, we connect, of course, in the United States and Canada, but we have incredible talent pool that we're tapping into, and so all core strategy that Bruce is leading for the development team, and then Amir Purnajab, who's our lead on managing all overall projects and delivery. All of our core assets are all master's level, PhD level in the highly sought after AIML skill sets areas, and we have a growing team of high professional capabilities in business and design that's really helping differentiate us. For business advisory, there's many organizations that we've been tapping into internationally, and both close to home and then also in the United States. We're actually participating in program connections within Silicon Valley in Austin, Texas. We were part of the Matter.Health program in Chicago, as well as the work we're doing here in Canada. I bring to your attention some of our professional advisories. Dr. Pierre Belanger, who is the professor and Cisco Chair in Healthcare at the University of Alberta, has over 10 patents to his name, and one of our key resources that we tap into for our ongoing technology strategy in these areas. And then Dr. Jacques Capundanu, a cardiologist and cardiology surgeon who works in Beth Israel Deaconess Medical Center in Boston, and one of the leading authors, noted authors on LinkedIn and in digital health strategies. And so really, really amazing resources for us in tapping into for driving clarity around our vision and approach on cardiology or metabolic cardiology interests. Business partners include a number of very high-profile organizations. National Research Council of Canada supports us. The Alberta Innovates, NIDE Labs, the Alberta Machine Intelligence Institute, and MITAX. A number of these organizations provide us with public sector supports, non-dilutive. And we have, again, I highlight some of the organizations we've been working with and industry partners in the United States and Canada, and we'll be continuing to grow on that. So that's my presentation, and really be pleased to answer questions and to connect with anybody who's interested in our company, and we'll pass it back over to Jack. Thank you.
Okay, Randy. So we got the full details, everything what's going on. So I want to talk about the in summary, in terms of the business model, right? Like what's going to be the average cost per customer? How many of these do you need to get that traction that the market's going to really get excited about?
Sorry, I was just getting a call coming on the side here. Maybe do a recap on that.
Okay. So the average revenue per user, right? That's on your system.
Yeah.
Your model is essentially going after these large organizations. They're going to have 5,000, 10,000, 50,000 users. Okay. But how much? But per individual, how much revenue per individual is that going to generate?
Revenue per individual on an annualized basis is in the range of $250 plus subscription services.
A year.
Annually. That's right.
Annually. Okay, so 250, right? So let's say you have, I think, what would you need to have roughly? I don't know. Let's call it 100,000 plus in the system for the market to be excited about that.
Well, it's for sure. It's it's easily over 100,000 end users on an annualized basis, and so we're seeing a massive market opportunity here that is in the hundreds of thousands. So the current state is really
the 100,000 is kind of the baseline. In other words, once you get to that, then the market's going to say, "Wow, this company's gaining traction." I mean, obviously, you don't want to stop there. Obviously, I think your goal is to have, I don't know, a million plus people on the system. That's
for sure. Okay. Yeah. Well, exactly. And so we're really focusing strongly on the North American market as our starting activities. And so we have a number of significant organizations that are really we've got that they start in.
Okay. So how long do you think it's going to take you right now to get to that first 100,000 people in the system?
That's going to take, I think, at least 2 years. So it's going to be interesting to see how traction really starts to frame up. So at least 2 years.
Okay. To get the first 100,000.
Yeah.
Okay. So 25. Okay. So and what? Okay. So in terms of starting to see people, starting to see organizations put their members on your system. How long? When can we start seeing that? When can we start seeing the first numbers starting to come in?
Oh well, basically the first half of this year.
Okay.
So there's a lot of, there's a lot of activity.
Basically, we're in March.
Oh, yeah.
So
Well, yeah, so by the end of June, we're definitely going to be seeing some really good traction starting. So this is a very key year. 2020 was a bit of had its different kind of challenges. So it created some really nice window opportunity to really bring companies like ours forward for attention. But it was, it wasn't the best year to be getting traction. This year is a great year to be getting traction on these topics, and so we're really seeing a lot of progress opportunity this year.
Okay. Okay, Randy, let's I think I don't know if I've ever asked you that. I've had Tim on before.
Yeah.
You're chairman. But what's I guess to recap, what's the vision for the company? Like, what is AIML going to look like? 3 years from now? Because you mentioned it's going to take a little while to get traction, but once everything starts kicking in, what's the big upside here?
Excuse me. For AIML, so HealthGauge is a core asset of AIML, but there's other investment opportunities that we're exploring over and above HealthGauge, and so the whole area of artificial intelligence, machine learning solutions is expanding in a number of different kind of core areas. So we're really also looking at other investments that align to our core strategy in digital health, and there's lots of different areas that we could see consolidating and reinforcing our value proposition. HealthGauge, I think, covers a tremendous amount of space around how we're going to be serving individuals in the prevention and ongoing health management, working with health professionals. But there are many other places, that we'll be providing more input to that a bit later this year, as far as how do we now bring more of those competencies, more of that solution capability into the doctor's office, into the health system, in labs, for example. Relating electrocardiogram further with the organizations that are tapping into labs and systems. So there's just a great amount of parallel and aligned areas that we are actively developing, frankly, in partnership and in investment potential.
Okay. Randy, what do you have? What else in terms of news flow, like immediate news flow? What do you have coming up? In the next, let's call it 60 days. What are the kind of any new partnerships? Anything that investors can keep an eye on?
Absolutely. We will be making some announcements around around some of these these partnership examples. And so when you look at the presentation I just provided, I think there's good clarity there on the overall solution. But what people are looking for now is also the additional input on the use case examples. And and there's a number of really important projects and partnerships that really will draw that out. So it's not just talking about the full stack solution and how that works, but actually showing the actual client and channel partner relationships that people really get excited about. And so we're really, so I tell you, like, in the next 2 to 3 months, 60 days, we are going to be bringing forward, those kinds of partnerships that really expose that in a much more direct way. And so, be looking out for that.
Okay. Excellent. Okay. So Randy, last question here before we wrap up. What, which we always ask is, in your opinion, right now, where the company is, early March 2021,
Sure.
In your opinion, top 3 reasons why investors should consider AIML shares today?
Right. The top 3 reasons I would say is really the clarity on our vision and market and the market interest that we're getting to really draw out that user base. So again, the partnership news that we'll be bringing forward will really express that a lot more. So that opportunity is huge. The second thing is the team that we've built and the connections we've created in both the United States and Canada. It is no small task to be able to bring forward that full end-to-end solution. Even the big players are struggling with this, and we have big players actually that want us to help them. And so we hope to be able to talk about those relationships later this year too. So, anyways, the team and our ability to execute on the market, and then finally, the other thing I think is incredible about what we're doing at AIML is the new investment and aligned investment opportunities we're looking at to really draw out even greater value over and above what HealthGauge is expressing today. So again, HealthGauge is an asset of AIML, but this is not where we're stopping. This is a starting point. And again, the team that we have and the competencies that we bring to the table to actually do the analysis on value add and accruative value to AIML is just the starting point. So, we're going to be really excited to share more about some of the other kinds of investment ideas that we're looking at to really grow the company.
So there's going to be other markets outside of healthcare that you can also address with the core technology.
Well, for this year, it's going to be digital health, but we absolutely can look at and will be looking at other industry opportunities. Because it's really how you manage those teams. And so yes, we are absolutely open to again looking to create parallel paths. But that's something we can talk about later this year.
Excellent. Okay. Randy, thank you again. We look forward to having you on the next live stream and getting the next big update.
Fantastic. Well, thanks so much for your time, Jack.
Thank you, and thank you everybody for joining our live stream today. We'll see you on the next one.
All right. Bye-bye.